Everyone, welcome back. In today's video, we'll be looking at Chapter 10, Capital Budgeting, slides 1 through 7 in the presentation. There's a brief mini exercise associated with this video, which I'm hoping you'll find easy. So let's get started. So capital budgeting. Remember, if you think back to important questions in finance, there were two of them. First of all, like what should our firm do, right? The capital budgeting decision. What big projects should our firm pursue? Should we launch a new product line? Should we acquire another company? Open a store? Close a store? Like big decisions that guide the goal of the corporation, right? Maximizing shareholder wealth. And then there's the financing decision, which was kind of related to the previous chapter, finding the firm's cost of capital. So in this chapter, we're looking at the capital budgeting decision. What should our firm do? So these are big, we'll talk about projects in this chapter. These are big, expensive things that are costly to reverse, and they have a huge impact on the goal of the corporation, right? So let's look at a couple of things we use to evaluate these projects. Here's a little outline of the steps. And we'll look at a couple techniques in this chapter. Today's video will just start with payback period and go from there. It was the first one. We talk about all these capital budgeting techniques because they're all used in practice. When we survey executives, people report using these and managers as well. So let's look at payback period. It's the oldest capital budgeting technique, and it's I feel like it's the easiest to compute, but it's the hardest for me to explain. So let me just illustrate it. And so why don't we take a look at this project. The payback period just measures how long it takes for a project to pay for itself. So if you look at this project, it costs, here's a typical cash flow timeline for a project where we've got a negative cash flow at time 0, where a firm maybe spends money purchasing assets to get a project off the ground, right? And then positive cash flows at years 1, 2, and 3. So evidently this is a 3-year project and kind of a stereotypical pattern in some projects. So year 0, we spend $1,200 to get the project started. The payback period measures how long do we have to go on this cash flow timeline until these future cash flows add up to a number that totals $1,200 or greater. So in this case, right, after 1 year, the project has recovered $400 out of its $1,200 cost. After 2 years, the project has generated $900 of cash flow out of the initial $1,200 of cost. And then we can see in year 3, after 3 years, the project will have generated $1,600 worth of cash flow. So the project pays for itself in year 3. We could make some sort of fractional year assumption and calculation if we wanted to be more granular. But for our purposes, we'll just say this project pays for itself in year 3. So why don't we take a look at a spreadsheet I've got to sort of log our work under other resources. Chapter 10, capital budgeting, will give us a place to show our work and illustrate how we're going to evaluate these projects. So here's all the numbered examples from the chapter. Here's this first project. And I don't really have a better way to say it, but this project pays for itself after 3 years, right? After 2 years, it's recovered $900 of its total initial cost. And then in year 3, the project pays for itself. So payback period is 3 years. So your mini exercise is going to be to look at a different project and determine its payback period. Mini exercise. This will be posted on Blackboard. So here's a cash flow timeline. Got a 5-year project in this case. And suppose it costs $2,000 to start. And then here's the future cash flows. Year 1, generating $800. Year 2, generating $400. Year 3, $500. Year 4, $350. And year 5, $700. So the mini exercise, what is this project's payback period? You'll find it in Blackboard under mini exercises. And you could submit your work there. So payback period, pretty easy to compute. And then, in determining whether a project is good or bad, we have to set some sort of threshold or how soon we need projects to pay for themselves. So like if a project pays for itself in 4 years or less, if that's our threshold, then this looks like a good project, right? If managers at our firm say, oh, no, we need projects that pay for themselves in 2 years or less, this one doesn't look like it's going to work all that well. So that's payback period. Easy to compute, but there's no discount rate. It ignores the timing of the cash flows. Separate, and then it also doesn't look at what happens after the project pays for itself. So if I've got two projects, suppose I've got two projects, X and Y. Here's project X. Both here, suppose project X is a 3-year project, and it costs $100 up front, $50 in year 1, $60 in year 2, and then $70 in year 3. We can see the payback period for this project is 2 years, right? This project pays for itself in 2 years. Payback period is 2 years. And then compare that to project Y, 0, 1, 2, 3. Suppose this also costs $100, and then it generates $30 of cash flow in year 1, $45 of cash flow in year 2, and then like $90,000 of cash flows in year 3. So this project takes longer to pay for itself. So if we just look at this metric payback period, right, project X looks better, but I hope any of us would realize that project Y is probably a way better project if you look at the cash flow that happens after the project pays for itself. So that's a big weakness of the payback period. So in the next video, we'll look at a much better, my favorite capital budgeting technique actually, net present value. So thanks for tuning in and see you next time.